Okay, so we're calculating M1, M2, and you said that we are going to look at 2006, right? 2006. To calculate M1, you're just going to say 49,951 plus 555,778, right? 49,951 plus 555,778, you're going to get 605,729. Then for M2, you're going to take that the figure that you're going to get, which is 605,229 plus 551,151. Then you're going to get, so you're going to say 49,151 plus 555,778 plus 555,778 plus 551,151. Then you're going to get 1,156,818. That is M2. Then M3, you're going to get the sum of M2 plus long-term deposits, which is plus 192,462. Then you're going to get 101,349,342. Right. And then also looking at the public sector, there are 5 causes of market failure: have monopoly and imperfect competitions, which we said with these markets are not efficient. That is why the government has to intervene. And then we also have public goods. You need to know the characteristics of public goods, whereby we said with the public goods are non-rivalry in consumption, meaning that the consumption of one person does not reduce the consumption of the other. And also said they are non-excludable, meaning that you can't exclude others from benefiting from the public goods. We also have externalities, whereby we have positive externalities and negative externalities, right? These are spillover effect. Also have asymmetric information, whereby we said with asymmetric information, this is where now you find out a buyer and a seller, they both possess different information about the product, which is why the government intervened now to ensure that all the information about the product is presented to avoid asymmetric information. Also have common property resources. We said these are resources such as fishes from the sea, which the government needs to regulate the consumption of those resources so that they are not exploited, or so that they do not so that we do not finish them, right? So for this video, we are going to only look at the externalities, because I did say we are looking at the graphs and the calculations, right? The other parts, you just need to go over them and know what is happening there. For externalities, there is one graph that I'm going to explain that you guys have to know, right? So what are externalities? Externalities can be also called spillover effect or neighborhood effects or third-party effect, right? This can be a cost or a benefit to a third party which is not involved in the production process, right? For example, if you're smoking cigarette, it can also affect the person next to you who's not consuming that product, right? In this case, that is a negative externality, right? Because that smoke would affect that other party, the third party, negatively, right? So we have negative externalities and positive externalities. Negative externalities, they are also called the cost. They are the cost to a third party, right? And positive externalities, they are the benefit to a third party. Examples of positive externalities can be building trees, planting trees in your community, right? That has a positive effect, right, to a third party. So negative externalities bring external cost, while positive externalities bring external benefits. The marginal social cost is greater than the marginal private cost for the negative externalities. This means that the cost to the society is greater than the cost that is felt by a producer. For example, someone producing something that has chemicals, right? Those chemicals would have a large impact on the society or in that community that that firm is located than the effect that it would have on that producer, right? So the marginal social cost is greater than the marginal private cost. And for positive externalities, the marginal social cost is less than the marginal private cost. So this is the graph I wanted us to look at. So with negative externalities, the government then tries to come in by doing what? By imposing taxes or putting regulations on products that have negative externalities, right? This is the government trying to do what? Trying to discourage the consumption of these products that have negative externalities. For example, alcohol and cigarettes, right? The government charges sin tax on these products to try and discourage the consumption of these products, right? So you can see that the price was P1 and the quantity was Q1, right? And then the government comes in and charge taxes, right? Then the price increased from P1 to P2 and the quantity decreased now because the price is high from Q1 to Q2 here, right? So this supply curve is the marginal private cost. This is the cost to the producers, and this is the cost to the society, right? Or external cost. This space here is called the welfare loss or the external cost, right? Because with the introduction of taxation, you can see that this was going to be the quantity that was going to be consumed. But now because of the tax is decreased to this here to Q2. So this space here is the external cost to the society or the welfare that has been lost. So you need to be able to draw this graph, yeah? Yeah. We have three important taxes in South Africa. We have the company tax, which is also called the proportional tax. That is where now the tax rate is the same for all taxpayers. And then we have value added tax, which is an indirect tax. It is regressive in nature. This is because the tax burden is felt more by low income earners. So low income earners end up paying more than high income earners for regressive tax. So this is where you would find out, so maybe you're given a question and you were calculating tax for two people, right? And person A, maybe let's say person A, their income was 100 rand. Maybe let's say the income was 100 rand and their tax was 10. And then person B, you calculated that okay, so their income was 200 rand and then their tax was 5. And then they ask you what type of tax. You can just say, good, see, this is regressive tax because low income earners, they're paying more. So the tax burden is felt more by low income earners. You can see person A is getting 100 rand, but is paying 10 rand as tax. And then person B is getting 200 rand, but the tax is 5. So this is then what regressive, right? Progressive will then be this one. Okay, so this one, now we move on to this one. This one is personal income tax, which is direct. This is direct because this tax is you pay it from your income that you earn, right? You pay this tax. And this one is progressive in nature. So for example, if you had a person A which was earning 100 rand and the tax is 10, then person B is earning 200 rand and the tax is 15. So you can see that this is progressive because high income earners pay more. So this one is getting 200 is paying 15. This one getting 100 is paying 10. So regressive is when high income earners pay more than lower income earners, right? So these are the type of tax that you must know. which is the company tax. The tax is the same for everyone. And then also called the proportional. Value added tax is indirect. You pay this one when you're buying goods and services. And it is regressive in nature because low income earners pay more than high income earners. Personal income tax, this one is direct. You pay it on your income, on your salary. So this one is regressive in nature because high income earners pay more than lower income earners. How to calculate total tax? You say basic tax plus marginal tax minus the tax rebate. So the tax rebate, it reduces the amount of tax that you pay. And we have primary rebate, which is applicable to everyone. We have secondary rebate, which is applicable to people that are 65 years and older. We have tertiary rebate, which is applicable to people that are 75 years and older. Effective tax rate. They can also ask you to calculate the effective tax rate or the average tax, which you get it by saying the total tax divided by the total income. So let's do this question. They're saying that here, Velma is 24 years old from Durban, has recently graduated in the University of KwaZulu-Natal. She has begun her first job as a credit risk analyst at Capitec Bank, where her gross monthly salary is 38,900. Given this information, okay, this is her gross monthly salary. Given this information, please use the table below to calculate her total payable tax and effective tax rate. And then number one, they ask you, Guti, what is Velema's annual salary? So obviously here we're given the monthly salary. So to get the annual salary, we're going to say 38,900 times 12. And then, so Velema, so V's monthly salary, annual salary is 466,800, right? Because you just take this, you multiply by 12, right? So you say 38. Then you get that. And then they're saying that how much is Velema's total payable tax, right? To get the total payable tax, you just say basic tax, um, plus marginal minus tax rebate, right? So the basic tax, okay, so firstly let's find Ruti, which tax bracket does Velema fall under? So he's getting 466 1,800. So you can see that here 466,800 is here. So he falls under this tax bracket. And then now the basic tax, obviously, it's this one, 7736. So you're gonna say 77362 plus marginal tax rate. So the marginal tax rate, they're saying that it's 31% of taxable income above 370,500. So you're firstly gonna take the annual salary, which is 466,800, right? Let me just do it here. You're gonna say 466,800. Then you're going to separate this amount here because they say that of income above this one. So you're going to say 370,000 or no, 70,500. So 466,800 minus 370,500, you're going to get 96,300 equals to 96,300. So once you have that one, you're then going to multiply by 31%, multiply by 31%, right? So times 31 over 100 gonna get 29,853. So equals to 29,853, right? So this is your marginal tax, right? So you're gonna add it here, 29,853, 2853, right? Yeah. And then you're going to minus your tax rebate. So this person is 24 years, so this person only qualifies for primary rebate, right? Because the primary rebate applies to everyone, then secondary 65, tertiary 75, right? So they only qualify for primary tax rebate, which is 17,000, this one here, 17,235, 235 equals to, so now you just say 77,362 plus 29,853 minus 17,235, you get 89,918. So it's 89,980, right? This is the total tax that is here. Yeah, but it's 89,980. And then they're saying that what is the effective tax rate? So to get the effective tax rate, you say the total tax that is paid divided by the total income times 100. So the tax that is paid is 89,980 divided by the total income, which is 466,800 times 100, right? So the tax which is paid is 89,980 divided by the annual income times 100, right? Times 100. Then you say equals to, so 89,980 divided by 466,800 times 100, you're going to get 19,27. So it's 19. So it's 19,27. Let me just say 3%, right? And then they're saying that what is the value of the marginal tax rate? So the marginal tax rates, these are the marginal tax rates, right? These ones. So for this one, it's 31%. You just take this one as it is. You just write it's 31%, 31%. And then now they're saying that if Velima's level of income increase after 5 years to 78,000 monthly, what is the value of the new marginal tax rate? So the one is to identify the marginal tax rate. So you're going to say 78,000 times 12, you're going to get 936,000, right? So, and then you're going to go to the tax brackets to identify which tax bracket will Velima fall under after 5 years when she's earning this income, right? Because the annual salary is 936,000. 936,000 is somewhere here, right? It's somewhere here. So the marginal tax rate is what? Is 41%. Right, we're done. And then now we're going to look at the foreign sector. Here you just have to be, this is chapter what? 16. Yeah. So here you just have to be able to differentiate between absolute advantage and comparative advantage and also calculate. So absolute advantage, this is when a country can produce goods and services at a lower, no, using the same resources or cheaper than another country. Right, that is absolute advantage. And then comparative advantage, this is where now the country can produce goods and services at a lower opportunity cost than another country. Right. So absolute advantage, they can produce using the same resources and faster or cheaper than another country. And comparative advantage, they can produce at a lower opportunity cost, meaning that what they are giving up to produce that particular product is less compared to another country. Right. So this is the question. They're saying that suppose you have been appointed as an economic advisor to President Joe Biden and are tasked with the responsibility to advise whether or not the USA should engage in trade with Australia considering two products, namely surfboards and sunscreen. The following table summarizes each country's production capabilities per month. So you're given Australia, USA, the surfboards for Australia it's 150, USA it's 200, sunscreen, Australia it's 900, and USA it's 1,600. The question is now saying which country has a relative advantage? So relative advantage is another term for comparative advantage, right? So they're basically asking which country has a lower opportunity cost in the production of surfboards and why. Show all your calculations and round off your final answers to two decimal places where applicable. So the formula I like to use here is the one that says not asked. Okay, this is the formula that I came up with. So you just say not asked over what has been asked, right? Right. So let's calculate the opportunity cost of of producing surfboards. Right. So the opportunity cost of producing surfboards. So what have we've been asked about surfboards? So it's gonna be 900 divided by 150. Because it's the opportunity cost of producing what? Surfboards. So 900 divided by 150, you're gonna get 6. And then opportunity cost of producing sunscreen. So it's going to be 150 divided by 900, right? So what is being asked? It's sunscreen. So it's going to be our denominator, 900. And then not asked, it's surfboards, which is 150. So I'm going to get 0, 0.1, 0, 0.16. And then the opportunity cost of producing surfboards again in the USA. So you're going to say 1,600 divided by 200, which is 8. And then the opportunity cost of producing sunscreens is going to be 200 divided by 1,600, which is 0, 0.125, 0, 0.125, right? And then they then ask Ruti, which country has a relative advantage in the production of surfboards? So for surfboards, it's here. So you can see that for Australia to produce one surfboard, they have to give up 6 sunscreens. And for USA to produce one surfboard, they have to give up 8 sunscreen. So the country that has the um lower opportunity cost or relative advantage in the production of surfboard is Australia, because they're giving up 6 sunscreens compared to USA, which was giving up 8 sunscreens, right? And then show all your calculations. Oh, we didn't show our calculation, so you're just gonna say 900 here divided by 150. Then equals to 6, and then also 1,600 divided by 200, which is, and then you're gonna get 200. I mean you're gonna get 8. Yeah. So we are done with this one as well. But if you ask ukuthi which country has an absolute advantage, maybe in the production of surfboards, you just basically you just look at which country is producing more. So you can see ukuthi this one is producing 200 surfboards and this one is producing 150. So a country with an absolute advantage is USA, right? Same here up. Same thing applies this side. Which country has an absolute advantage? It's USA because they can produce 1,600 sunscreen, while this side they can produce 900. Right. Also, its advantage you're saying the country can produce more given the same resources. Also, you need to be able to I'm not sure. Maybe you might be asked to draw the graphs or whatnot. I don't know. But okay, what is the depreciation? It's when the value of the currency decreases and then or the currency loses value. And then appreciation, it when the currency it gains value, right? Or the value of the currency increase. So the there can be a change in the demand or the supply, and and this is what may cause the changes, right? For number one, they can say that the demand for dollars may increase because of the following factors. So when SA firms purchase more US capital, or because more SA tourists visit the United States, right? So let me just, this is your supply, this is your demand, right? Right. This is the prices of rand in dollars. Right. So they're saying that the demand for dollar can increase. So let me just increase the demand for dollar. So let's just say it's going to increase here. Or the question might say the demand for dollar, what may cause no, they may say what would happen to the rand when the demand for dollar increase, right? So then you then draw this graph here. Firstly, you ask yourself, okay, what could cause the demand for dollar to increase? The demand for dollar can increase because the people from South Africa are purchasing things from the US, right? So obviously, when you want to purchase things from the US, we need to use the dollar to buy those things, right? So the demand for dollar can increase. Or when the tourists from South Africa wants to travel to the US, obviously they're gonna need the dollar, right? So the demand for dollar will increase like this, which will then cause the price to increase, right? You can see it's going up. The the prices of rent in dollars, and then you can see also the quantity is going to increase. The quantity of dollars that are demanded is going to increase. And then what would happen to get to your curve? Obviously, they said we see there be a shift in the demand curve to the right, as you can see. And then to the rand will depreciate. So you can see that here, because the more people are going to USA, the tourists are going to USA and they're demanding the US dollar, right? And also, most people are buying things from the US, and so they're demanding the US dollar to buy those things. So what would happen is that more of the rand will be supplied, right? Because we are demanding the dollar, so we'll be supplying more of our rand so we can get the dollar. So the rand will then lose value, right? So it will depreciate. And then what happens to the dollar? The dollar will then appreciate because the demand for dollar has increased, right? So the price of rand in dollars will do what? Will increase. This it shows Uguti now we're gonna need more rand to buy dollars, right? Which is why the dollar price will then what? Will appreciate. Same thing applies here. If the supply for dollar increases, right? Let's now increase the supply for a dollar. So this is the supply curve, and this is the demand curve, right? Then let's say the supply for dollar increases, so it's going to increase on this side. So you can see, okay, fine, the supply for $1 is going to increase. So what would cause an increase? They're saying that the gold prices increase. So if the prices of gold increase, obviously you know that South Africa supplies gold to the rest of the world. So if the price of gold increase, meaning that more dollars will be needed to buy our gold, right? So they'll be supplying more of the dollar. And then all the firms in US are buying our minerals. So if they are buying our minerals, so they'll be supplying more of the dollars to buy our products. So you can see that the supply is going to increase and the quantity which is demanded for the dollar is going to increase. The supply is increasing, so it's going to go this side. Then the price is going to decrease, right? The quantity supplied is going to increase, and then the price is going to decrease, right? So this is the price of rent in dollars is going to decrease. Why? This is because obviously the people in the US, they're going to be supplying more dollars to us because they are demanding our product, right? And which means that now for the prices of the rand to dollar is going to decrease. It then becomes cheaper for because they're supplying more of their dollar. We then gain the foreign currency, which will then make our currency to appreciate, right? Causing the dollar to depreciate because now it means you would see the price of this is supposed to be the price of dollar in rands. Yes. So this is supposed to be D is to R, the price of dollar in rand. So meaning that now the rand which will be required to buy the dollar is actually what? The price is decreasing, right? Meaning that now you need, maybe back then you needed, maybe let's say this is 10. You needed 10 rand to buy the dollar, but now you need what? You need 5 rand to buy the dollar, right? So the rand gains value in this case, right? It appreciates and the dollar will do what? Will depreciate, right? And then let's look at another situation where now they're saying that the supply of dollar decrease. So the supply of dollar decrease. So this is your supply, this is your demand. So this is your demand, and this is your supply. So the supply of dollar decrease is going to decrease on this side. So you can see that the price will increase and the quantity supplied will decrease. Right, it's going to shift on this side. So the prices of dollar in rands. So you can see now that if the supply of a dollar decreases, so what could cause a decrease in the supply of a dollar? It's the gold price fall. So if the prices of gold decreases, it will then decrease the supply of a dollar. Or because the US citizens stop investing in South Africa. So meaning that people in the US they stop investing in South Africa. So they stop giving us their currency. So the supply of a dollar will do what? Will decrease. So if the supply of a dollar decrease, you can see that the quantity that is being supplied for dollar is going to decrease, obviously, and then the price is going to increase. So the price of dollar in terms of rand is going to decrease, meaning that now the prices for you to buy dollar, the price is going to increase. You see, so it means that the rand will depreciate because more rand is now required to buy the dollar, and the dollar is going to appreciate, right? So if you drew your graph and the price increase, it means you would say the rand depreciates. But if you draw your graph and the price decrease, it means the rand appreciated, right? So let's look at this last one. So you have your supply here, and you have your demand, and then this is your price, your quantity. And then they're saying that now the demand for dollar decrease, right? So the demand for dollar decrease, it's going to decrease on this side. Okay, so you can see that our price has decreased. So already we know the rand will do what? Will appreciate, right? So the price decrease, meaning that to buy dollar, fewer money is needed in terms of rand is needed to buy the dollar, and then the quantity also decreased. Yeah. So the rand will appreciate because let's say you needed 10 rand to buy the dollar, now you need 5 rand. So it means that the rand has gained value. So the rand appreciates and the dollar will depreciate. The impact of changes in the rand or the dollar exchange rate, no graphical illustration needed. So if the rand depreciates against the dollar, what happens to export prices? The export prices will decrease. So if the rand depreciates, it means that the rand loses value, right? It loses value. So if the rand loses value, it means we would see the export prices, remember, export is like us selling to the rest of the world, right? So if the rand loses value, it means that it becomes cheaper for people outside to buy our things because it loses value. So the export prices will decrease and the import prices will increase, right? Because our rand has lost value, right? It means we would now for us to buy things from outside, from the US, from China, we need more of the rand because at the moment it has lost value. So our imports are going to be expensive for us. So import prices will increase. And then the current account will do what? It will improve, right? So the current account will improve because remember in the current account, we have our imports and exports. And we look at our export as expenses, no, as income, and our imports as expenses. Right, because our imports, this is the money leaving the economy. And our exports, this is the money coming in to the economy. It's an injection. So if the exports are decreasing, wait, with the export prices, they decrease. So if the export prices decrease, it means that the exports are going to increase. If the prices are low, more people are going to be buying from us, so more money will be coming in. And then if import prices increase, we will be discouraged to buy from outside, right? Because obviously the rand has lost value, it has depreciated. So we end up buying things from within the country, right? Domestically. So the current account will improve because we will have the exports will be greater than imports. So the current account will improve. And then domestic prices will increase. They will increase because remember I said routine, the rand has lost value, it has depreciated, meaning that the export prices will decrease, so exports will increase. Right? If the price decrease, more people are going to be buying from us, right? So exports are going to increase and imports will decrease because our import prices will increase. Right, they will increase because the rand has lost value. So now it is expensive for us to buy from outside, right? From the US, from China. So we will be discouraged to buy from outside. We will then go to where? To the domestic markets, to our Mr. Price and so on, right? So them in Mr. Price and so on, they'll see it's okay, people are buying from us now because the rand has depreciated. You know what? Let's increase our prices before the rand appreciates and they start buying from the rest of the world again. Right? So domestic prices will rise. Because they see whose value, we have no choice but to buy from them, obviously, because the rand has lost value and it is now expensive to import because import prices have what increased, right? And then if the rand appreciates against the dollar, it means the rand gains value, right? So it is now cheaper for us to buy from outside because the rand is stronger now. So the export prices will increase. meaning that people who want to buy from us would have to pay a higher amount because the rand has appreciated, it has gained value. So the export prices will increase, meaning that the exports themselves, they will decrease. Because if now to export it is now expensive, people would be like, okay, no, let's just not buy from South Africa for now because the rand has gained value. Right. So the export will decrease because the export prices will increase. And then the import prices will decrease. So the price for imports will decrease because the rand has gained value, has appreciated. So it is now cheaper for us to buy from outside. Right. So imports will increase. Imported goods will increase because import prices will decrease. And the current account will worsen. Why? Because in the current account, remember we have exports and imports, and we look at our exports as like an income and imports as like an expense, right? Because this is money leaving the economy for imports, and for exports, this is money coming in. It's an injection. So if the export prices increase, it means that less goods will be exported, right? So if we are selling less to the rest of the world, it means that the income that we're getting is also less, right? It decreases as well. While because the rand has appreciated, import prices become decrease or it becomes cheaper for us to buy from outside. So it would then lead to more people buying from the rest of the world, meaning that our currency will be leaving the economy. More people will be supplying our rand, right? So money will be leaving the economy, right? So that we would have more leakages than injections, which will lead to the current account to do what? To worsen, right? And the domestic prices will fall. Why they would fall? Because remember, the rand has gained value, right? And most people are buying from outside. They're importing because import prices have decreased. So your the domestic market, for example, Mr. Price, they will try to reduce the price of their products so that we can also come back to them, right, and buy from them. So that is why the domestic prices will do what? Will fall. We also looked at chapter 18, 17, and 18, which is a simple Keynesian model. So in the simple Keynesian model, that is where we said, Dulcie, we have this person by John Maynard Keynes, who believed that yes. So we have John Maynard Keynes, um, who believed that demand creates supply, right? He believed that for that in the economy, there firstly has to be the demand for products, and then that demand for products will then push the producers to then produce those goods and services, right? The aim of the Keynesian model is to explain how national income is determined. And then we also have, I think you need to know these economists, John Maynard Keynes, who came up with the theory that demand creates supply. And then we also have Say's law, right? This person is Jane Baptiste Say, who also says that supply creates demand. So I feel like if you know John Maynard Keynes, it'd be easy to remember this one because John Maynard Keynes says that demand creates supply, right? He's saying that they first have to be a demand for goods and services, and then that will then lead to our producers to produce then those particular goods and services because there is demand for those goods. While Usay says that there firstly has to be supply, and then supply will stimulate what? Demand. Right. So we have a simple Keynesian model or a two-sector model. That is where we had looking at two sectors, which is the households and the firms, right? In a simple Keynesian model or in a two-sector model, right? And we had the consumption function right? Where the graph looked like this. Right, so this is the consumption function. The consumption function, it basically shows the relationship between disposable income. So it shows the relationship between consumption expenditure by households and the total income, right? The consumption function. So whereby this side we have expenditure, and then the side we have Y for what? For income, right? So there are three important characteristics of consumption that you have to know. One is that consumption increases as income increase, right? So you can see consumption is like this. So as your income is increasing, going this way, right? Your consumption function will also increase like this, meaning that there's a positive relationship between consumption and income. If income increase, your consumption also increase. Also, consumption is positive even if income is zero, right? So you can see that consumption will never start at zero. It always starts somewhere here, right? This is because we have this autonomous consumer, right? Who would always consume something even if their income is what? Is zero. So consumption will always be positive even if income is zero. And then when income is increasing, consumption is also increase, but the increase in consumption is less than the increase in income, right? So if consumption will always increase together with income, but the increase in consumption will always be less than the increase in income. That is because some of the amount will be consumed and some of that income will be saved, right? And then for consumption, we said it's the C bar here plus CY, right? The equation, whereby the C bar here is autonomous consumption. Remember, we have two types of consumption. We have autonomous, where we said this consumption occurs even if income level is zero. That is why your consumption function will always start somewhere here. And then plus CY, the C, small letter C for marginal prosperity to consume, times Y for income. This is because for an induced consumer, some of the income will be consumed and some of the income will be saved, right? And the savings function also looks something like this. It's minus C bar because this autonomous consumer, we assume that they never save, right? Because obviously, even to consume, they use their saving or they borrow money for them to consume and so on. So these ones they never save. So that's why we have a negative C bar plus SY, right? This S for marginal prosperity to save times Y for income. And if you add the C plus Y, you should always get 1, right? If you add your marginal prosperity to consume plus your marginal prosperity to save, you should always get 1. That is because for every income that a person has, MPC plus MPS, you should always get what? You should always get 1. This is because for every income that a person has, they can choose to save some of it and consume some of it, right? And then we also have investment spending. Remember, in a simple Keynesian model, we only have two sectors. We look at firms and household, right? And for firms, we look at consumption expenditure for households, we look at consumption expenditure by household. And then for firms, we look at investment, right? So investment, this is the purchase of capital goods, right? Your machinery, your buildings, and your equipment. So there are three important variables or determinants of investment, which is the cost of capital good. So for you to purchase this good, you need to also firstly determine the cost and also determine the interest rate and also the revenue that you expect to receive from this capital good, right? The investment function is like this. Investment is also autonomous because it does not have any relationship with income, but rather has a relationship with the interest rate, right? Whereby we say, Guti, if the interest rate are high, the return on investment is low, but if the interest rate decreases, the return of investment does what? Increase. So investment is also autonomous. And then we look at the equilibrium level of income. So you have your graph like this, whereby here you have your, your aggregate expenditure. Because we're looking at a two-sector model so far, so we're going to say that where your aggregate expenditure will be equals to your C plus I, right? And then you have this line here, which is called the 45-degree line. This 45-degree line, it is where your aggregate expenditure equals to your income, like this, equals to your income. And in the 45-degree line, it basically illustrates all the possible equilibrium points, right? So here, where your 45-degree line intersects with your aggregate expenditure curve, the income, if income is 10, then it is equal to aggregate expenditure, and aggregate expenditure is also 10, right? Because this shows all the possible equilibrium points. So this space here indicates the excess supply. This is excess supply because aggregate expenditure curve, which is this one, is below the 45-degree line. And here you have excess demand because your aggregate expenditure curve is above your 45-degree line, right? So this one you have to know, go to the 45-degree line, it basically shows all the possible equilibrium points. And then we introduced the government into our simple Keynesian model, and this became the three-sector model. So the three-sector model is the one that consists of the households, the firms, and the government, right? And then obviously when we're introducing the government, our our graph is going to increase. So let's say we had our graph here, which is C plus I. And then now because we're introducing the government, the curve is going to increase like this. Because remember here, we have all our autonomouses, right? So if our autonomous consumption was, if the autonomous consumption was 10, right? And the autonomous investment, this is I, was 5. It means here we have 15. Our graph starts at 15, right? Because we add all the autonomous components. But now we're adding government. Also, government is autonomous because this government is a political issue. It does not relate to income. So if we add government and maybe autonomous government spending is also 10, it means we're going to say 15 plus 10. So now the graph will start here at 25, right? So the government does not affect the multiplier, the size of the multiplier. However, it does affect aggregate expenditure as well as income, right? Because you can see that your aggregate expenditure is going to increase because of an increase in government, and also the income here, which is Y, is going to increase. Let's say we had a 45-degree line here. You can see now that our point was here, now it's going to be here. So our income is going to do what? To increase as well as our aggregate expenditure, right? So addition of the government in our Keynesian model will affect your aggregate expenditure as well as your income, but it does not affect what's the multiplier, right? And then because of introducing of the government, we also introduce tax, right? We introduce tax because taxes are used to finance government spending, right? They're used to finance government spending. And your taxes, they leave the aggregate expenditure unchanged, so they do not affect your aggregate expenditure. However, they do affect your disposable income, right? And also they reduce the size of the multiplier, right? Remember when we're adding taxation, to calculate the multiplier, we say 1 divided by 1 minus MPC into 1 minus T, right? For proportionate tax, right? So taxes do reduce the size of the multiplier, and then they also reduce the equilibrium level of income, right? This is because they affect what's your disposable income. Remember, to calculate disposable income, you say YD for disposable income equals to Y for income minus T for tax. You get your disposable income, right? And then to get the total tax, you say T, small letter t times Y, right? So for this part, what you have to know is that government does not affect the multiplier. However, it does affect your aggregate expenditure as well as your income. And then introducing taxation also affects your multiplier. It reduces the size of the multiplier. And it does not affect your aggregate expenditure or your autonomous aggregate expenditure. It also reduces your equilibrium level of income. That is because tax affects your disposable income. Then you also have to be able to calculate the total tax, which is tax rate times income. And then you also add the foreign sector to our Keynesian model. Now it becomes the four-sector model. Remember, with the foreign sector, we interact with them via exports and imports, right? Exports are an injection in the circular flow because that is money that is coming in, right? Remember, exports, we are selling to the rest of the world and they are buying our products. So money is coming in, it's an injection. And export is autonomous with respect to income. That is because this is the income that is from the rest of the world. It's not our income domestically, right? So when people are buying from us, they're using their money, right? It is not linked, it is not linked to the level of income in the domestic economy, right? It's not linked to our income. So export is autonomous. And then import imports, we have autonomous components and an induced component because we have people that import goods, but even when their level of income is zero, then we have people that import goods, um, and they're actually getting some form of income. So imports reduce the size of the multiplier. And also, imports represents a leakage. So imports are a leakage in the economy. That is because that is money that is leaving the economy, right? Because when you're buying from the rest of the world, you are paying, right? So money is leaving the economy. So also the thingy for import, it's what's this? The equation, it's autonomous import plus your marginal prosperity to import, which is M times Y, right? And then it reduces the size of the multiplier because of this M here. Because remember, now because of exports, our multiplier, it's 1 minus C for MPC, and then 1 minus T for tax, proportional tax, and then plus M for marginal prosperity to do what? To import. Right, so it's going to reduce the size of the multiplier. Obviously, when your denominators are increasing, the figure that you get will be smaller. Let me see. If you say 1 divided by 3, you get 0.3. But if you say 1 divided by 5, you get 0.2. Yeah. So if you're dividing by a bigger denominator, obviously the answer will be smaller than when you're dividing by a smaller number. So as you're increasing your denominator, the multiplier gets smaller. That is why they say that your imports, they reduce the size of the multiplier, as well as your tax, they reduce the size of the multiplier. So here you just need to know what the exports, they are autonomous, and import, we have an autonomous component and an induced component of import, right? The one that is dependent on income and the one that is not dependent on the level of income. And then imports reduce the size of the multiplier. And then here is a question. They're saying that here calculates the value of the multiplier. With this one, the questions will always be the same. With the most questions that I've seen so far, they're just the same. You calculate the multiplier. After that, you calculate the equilibrium level of income. After that, they will ask you to determine whether the government has made a deficit or a surplus, and also you'll be asked to calculate the new income now. If maybe they say, Guti, there was an increase in investment or an increase in, yeah, but the calculations are always the same. So please get this one. So number one, they're saying that calculates the value of the multiplier, right? So you know that to calculate the multiplier, you just say 1 divided by 1 minus C into 1 minus T plus M. Right. So you just say 1 divided by 1 minus your marginal prosperity to consume is this one, 0.6, 0.6 into 1 minus your tax rate is 0.167, 0.167 plus your marginal prosperity to import 0.125. Then you're gonna get 1.599. So your multiplier is 1.5. Let me just say 1.6 because 1.599, which is 1.6. Right, 1.6. And then remember when you're doing the calculation, start with solving the bracket first, and then you can continue. Just to show that second step, because there is a mark for that second step. And then calculate the equilibrium level of income using the value of the multiplier. So calculating the equilibrium income, you just take your multiplier times all your autonomous aggregate expenditure components. So your multiplier is 1.6. Your autonomous aggregate expenditure components, it's what? It's 30 plus 10 plus 20. Autonomous consumption, which is 30 plus autonomous investment, which is 10 plus autonomous government expenditure, which is 20 plus autonomous export, which is 10 minus 5 for import, right? Minus 5, you're getting 65. So you're just going to say 1.65 times 65. And then you're going to get times 1.6, 104. Right. And then continue. They're saying that suppose that the government decides to give a basic income grant. This will increase government expenditure by 4 million. So it's going to increase by 4 million, right? They didn't say two, they say by. So from the government expenditure which we have here, we're going to add plus 4, which is going to make this to what? To 24. Right. And then and to finance its average tax rate is going to increase to 0.25. So this one is going to increase 2. Right? So we're going to cancel this one. Oh, I'm sorry, not this one, this one. So now the average tax rate is going to be no longer 0.167, but now it's going to be 0.25. Okay, this 0 looks like 6, but it's 0.25. 0.25. And then calculate the new equilibrium level of income. So firstly, we need to calculate the new multiplier. And then after that, we're going to calculate the new autonomous aggregate expenditure. And then we're going to multiply the multiplier by the autonomous aggregate expenditure. So our multiplier is going to be 1 divided by 1 minus MPC. Our MPC is 0.6, is still 0.6, this one, into 1 minus our average tax rate is now 0.25 plus marginal prosperity to import is 0.125, which will give me which will give me 1.48. Right, so the new multiplier is 1.48, which is just 1.548, and then multiply by our autonomous aggregate expenditure, right? Which is going to be autonomous consumption 30 plus autonomous investment 10 plus autonomous government spending. Remember, it's no longer 20, but it's 24 because they said that it increased by 4 million. So we said 20 plus 4, we got 24. It's going to be 24 plus autonomous export, which is 10 minus 5 for import. So I'm getting 69. So we're going to multiply that by 69, which should be equals to, so 69 times 1.48, I'm getting 102.12. Right. And then 7.4, they're saying calculate the tax income that the government receives at the new income level of question 7.3. So they want us to calculate the tax that the government will receive. So remember, to calculate the tax, we say that is T equals to small letter t times the income. Right. So the tax rate in question 7.3, it increased to 0.25. So it's going to be 0.25, going to be 0.25, 0.25 multiplied by income, which is this one, which you calculated here, which is 102.12, right, 0.12, right, which is going to be equals to, so 0.25 times 102.12, 0.25 times 102.12, you're gonna get 25.53 million, right? This is millions of rand, so 25.53 million, right? They can also ask you, is the government making a deficit or a surplus? So you just take your tax that you've calculated, then you compare it with government expenditure. So government expenditure is 24, right? It's 24 million. So you can see that the government is spending 24 million, but the government is receiving 25 million in taxes. So there's a surplus, right? Because the expenditure is 24 and the tax is 25, so it's more. So from this 25 minus 24, they're spending 25 and the government is left with money with 1 million, 53 cents. You see, so they're making a surplus. So for this one, you just have to be able to calculate the multiplier, the equilibrium level of income, and yeah, the tax. That's all. Okay, so we are done. I wish you guys all the best.